Good morning. It is the last Monday of March, March 30th, 2026 here. So mortgage rates are still hovering around recent lows, but the big question is, what are they about to do? Are they about to stay? Are they about to move again this week? So even though they're around recent lows over the last couple years, we've seen an increase here over the last couple weeks. So uh, this has started to bring buyers back into the market. So I can tell you firsthand, we're seeing more activity, more showings, more competition on offers again. But rates obviously reacting to lots of things, not just the Feds. They're reacting to anything that involves expectations of any kind. This week, we're watching for inflation data, jobs data, overall economic strength, to decide what happens next with interest rates. Now, obviously, we're also going to be waiting on what's going to happen here in Iran and the Strait of Hormuz. This oil situation has created expectations of inflation fears. And so if inflation cools, rates could improve a little bit more. If we get stronger data, then rates could move back up quickly. And we've seen that a couple different times where rates are up and down, up and down. So lots of volatility right now with interest rates. There's economic reports that are released every week. So it's been an absolute roller coaster over these last couple weeks. So if you just kind of search in news today, you'll see that rates are elevated. Right now, we've got rates over 6.5% average, whereas just a month or so ago, we were at 5.99. So we had a couple days that were just absolutely killer. And you can see that in the charts here. This day here, it was 70 basis points that we lost in one, which is pretty significant. But then we see all these little attempts to try to recover, and then, oh, we don't like something. And then here we come again, and we don't like something. Today, we've already gained another 25, ish basis points, almost 30 back. So we could start seeing this happen again. But the question is, does it stay on this path and keep coming down, or does it just keep, going back up and down and yo-yoing? So the other thing that's very important for you to remember, especially if you're interested in a mortgage right now, whether it's refinancing or buying a home or even buying rental property, is what you see online or in the headlines is delayed. The real market moves daily and then even multiple times per day. So what you're seeing on the news is not the interest rates that we're offering from the lending market. So make sure, have a plan. Do not try to time the markets. I'm going to keep saying that over and over, screaming from the rooftops. Don't try to time the interest rate markets. The better strategy is to take advantage of opportunities when they show up and build a plan to refinance later if rates improve, which they'll improve eventually, because real estate isn't about a perfect rate right now, pushing your budget to the absolute max levels. It's about a long-term strategy that works for you and then continuing to improve it over time. So if you're thinking about buying, refinancing, or want to talk strategy at all based on your situation is going to be different than anyone else's situation. You might have similarities, but you're one, they are somebody else. So reach out to me directly. We'll put a personalized plan in place. The other thing that everyone loves to talk about is this 10-year Treasury. You can see here we're back up to 4.36. You can see this chart's moving up. It's just like this one here, where we're following the rates up, right? But this is a sharper incline here on the interest rates versus the 10-year Treasuries. These things move slower. It's not a direct correlation. They do work in tangent, but they're not directly related. Interest rates can shoot up really high, even if this is only moving up tenths, right? This was 3.99 not too long ago. So keep it in mind, long-term plan. There's way more conversations about there to have around debt, credit card spending, your debt to income ratios. Where are they? Where do we want them to be? How do we improve your credit score so that you can even get the top interest rates in the market? What we see here are averages, and this is going to be based on the best credit scores, the best down payments, probably even buying down points a little bit. This is just the rates that are coming through that can be calculated. and put in the averages. So if you don't have excellent credit, if you're not 780 or higher, 760 or higher, then let's talk. What can we do? What can we inch you up a little bit more? Or if you're in the 600s, how can we get you in the 700s? All these little things matter. Personal spending is something out there that's probably limiting people more than interest rates. So don't always blame interest rates on the affordability right now. Let's look at a full picture. Let's take a full total analysis of all your debts and costs versus your income coming in. That's what underwriters are doing anyway. So let's find opportunity, let's prepare, and then let's watch these rates closely, and we'll be able to put a strategy in place where real estate will work for you. It will hedge against the stock markets like it's supposed to do. So let's keep our eyes on the prize. I think we'll have a great week, and let us know if there's anything we can do to help you out.